Welcome everybody. Glad to be here with you today. Today's presentation is on options, and I'm going to show you how we crush the market with options. There's a lot of material I'm going to cover. I may have to go through some of the sections fairly quickly, but I'll do my best to cover it all. Let's get started. For those of you who are joining us for the very first time, here at Trading Wins, we are a group of pro traders with well over 30 years of experience. We're real traders and real teachers, and we've been developing our own systems and strategies and teaching people from complete beginners to experts around the globe. Now, in today's presentation, I am going to share with you some of the option basics you need to know to start trading options, and why and how you would trade simple calls and puts. I'm also going to teach you how to trade during these periods of increased volatility, which we've seen lately, but more specifically, give you a method of how you can trade around earnings season the right way. And of course, how to protect your positions with options. This is one of the key benefits of options. And I'm also going to talk a bit about who actually makes money in the options market, because I'm sure, as you hear in the media, most people lose money when it comes to trading options, but I'm going to show you who exactly makes money and how you can as well. Hopefully we'll have time for Q&A as well at the end of the presentation. Please do remember that trading is risky if you don't know what you're doing, so please be 100% comfortable with what you're doing and the strategy you're using before you trade with real money. Now, a couple of quick poll questions just so I know who my audience is and I can tailor my examples to you specifically. How many of you have seen me present at a webinar or event such as this before? Please just take a moment to type in a Y or an N for yes or no. I really do appreciate it. Thank you very much. Appreciate that. It's about 50-50. How many of you have actually traded options before? Or are you completely brand new to it? Please take a moment to ask that. Wayne says never, no worries. I'll try to walk you through this as best as I can. Excellent. One last poll question. For those of you who have traded options before, on average, how many trades do you place per month? Is it 1 to 10, 11 to 20, or are you much more active than that? Please take a moment, type in your selection. Excellent. Okay, so there's several of you here that are fairly active with options. The great thing about options is you have a lot of options with options. We always say that. There's a lot you can do with options. I'm going to cover a portion of that today. But there's a lot of myths and out there, and I'm going to try to clear up a couple of those for you today. One of the most common myths when it comes to options is that they can be very complicated to trade. Well, the truth is that once you do learn how to trade this, they can actually be very simple to trade. Another myth out there is that they can be extremely risky. Well, of course, that is only if you don't know what you're doing. Once you learn to trade them the proper way, they can actually be extremely safe. I believe they're much safer than trading stock. But the key to your success is knowing when and how to trade, and that's the real key, and that's what I'm going to try to help you out with today. So, covering some of the basics here, a call option. What is a call option? A call option gives you the right, but not the obligation, to buy a specific stock at a fixed price, known as the strike price, anytime before a specific expiration date. On the flip side, the option seller is obligated to sell you that stock at that specified strike price if the holder of that option contract decides to exercise that contract before expiry. Now, when it comes to a long call, your profit and loss potential, your profit potential is unlimited because that underlying stock can increase, can continue to increase. Your potential loss, though, and this is one of the real benefits when you're long an option, is that it is limited to what you paid for that contract to begin with. So if you've paid $1.50 for that contract, that is the absolute most you can lose under any scenario. It is impossible to lose any more than that when you are long an option. If you are short the option, your profit's limited to the premium that you collect from the sale of that option, but your loss is unlimited because that stock can continue to increase. So it's the flip side to that. But the real difference here is in your probability of profit, and that's what we'll spend some time on today. When it comes to put options, it's really the same thing, only talking about the sell side. So a put option gives you the right but not the obligation to sell a specific stock at a fixed price, known as a strike, anytime before the expiration date. And the put option seller would be obligated to buy that stock from you at that strike price, should you choose to exercise your option. So when it comes to the potential profit from a long put, it's substantial and it increases as that underlying stock starts to decrease and moves towards zero. Your potential loss, same as a long call. Remember, when you're long an option, you can only lose what you paid for it. So it will always be limited to the premium that you paid for that put. When you're short a put, your profit, again, is going to be limited to the premium received from the sale of that put, but your loss can be substantial, and it will increase as that stock price starts to decrease towards zero. Now, when it comes to options premium, the one option contract is the equivalent of 100 shares of underlying stock. So, for example, if you're going to buy one option contract and it costs $1.50, your actual cost would be $150. You always have to multiply it by 100. Okay, the number of contracts you have times 100 times the price you paid for it. That would be your total outlay. What type of option contracts can you buy? Well, you can certainly buy stock options, and there's thousands of optionable stocks on the U.S. markets, and nowadays there's more and more weekly options. There's hundreds of them, and these have really given option traders a lot more to work with recently. I'll touch on that as well. You can buy options on the stock indexes like the S&P 500. That is the most popular, or symbol being SPX. You can also buy them on futures, such as crude oil, gold, wheat, coffee, you name it. Most of them have options that you can purchase. A few key terms that you need to be aware of. In the money. This is a call option with a strike that's below the current market price of the underlying, okay? Or a put option with a strike above that underlying. The out-of-the-money amount, out-of-the-money, otherwise known as OTM, is a call option with a strike that is higher than the market price of the underlying, or a put with a strike that's lower. Okay, a lot of this will make a lot more sense once I pull up my charting platform and actually pull up the option chains and go through a few examples. But the at-the-money, or ATM, is the strike price that is closest to the current market price of the underlying. A few other terms: there's intrinsic value, there's extrinsic, and then there's implied volatility. And think of the intrinsic value as the in-the-money portion of that option contract. The extrinsic value is the out-of-the-money portion, otherwise known as the time value. The more time you have to expiration, the greater the extrinsic value portion of that option. And implied volatility is the estimated volatility of a security's price, okay? And in general, implied volatility will increase when the market is bearish and decrease when the market is bullish. The reason for this is that markets tend to drop a lot quicker than they go up because of that panic factor that sets in. When markets start to drop, they'll do so quickly, which results in a spike in implied volatility. Okay, we'll talk about that as well. A few other facts. Options are only risky if you don't know how to trade them, okay? But another fact is that over 80% of all option contracts expire worthless. This isn't a myth, this is actual fact. So as an option seller, you have a much greater potential for making a profit than an option buyer, and I'll clarify that in the upcoming slides. Most people only buy options, and they do so without taking that fair value or implied volatility into consideration. So what ends up happening is that they end up buying overpriced options and end up losing money even though the underlying stock moved in their favor. This is so common, but it is avoidable, and I'll show you how. Now, here's the real difference between buying options and selling options. Really want you to pay attention to this. When you're buying an option, only 5 things can happen, or when you take a position on a stock, only 5 things can happen. Okay, that underlying can move in your favor by a big amount. It can move slightly in your favor. It can do nothing. In other words, it can consolidate sideways. It can go slightly against you, or it can go against you big time. And here's the difference. When you're buying an option, if it moves in your favor by a large amount, you're definitely going to make money. If it moves in your favor slightly, you might make money. And this is where that fair value and implied volatility come in, because if you don't know how to read those or use those to your advantage, chances are you will be buying an overpriced option and you will lose money even when it moves slightly in your favor. Okay? But here are the real keys when it comes to buying options or going long contracts. If the underlying moves sideways, you're going to end up losing money. If it moves slightly against you, you will lose. And if it goes greatly against you, you'll definitely lose. So even when you do take implied volatility and fair value into consideration, you still at best have a 2 out of 5 chance of making money when you're going long. When you're selling option contracts, the same 5 scenarios can take place. That underlying can move in your favor by a great amount, slightly in your favor, it can do nothing, go slightly against you, or go against you by a large amount. But here's the difference. When you sell that option contract, if the underlying moves in your favor by a large amount, you will definitely make money. If it moves in your favor slightly, you will make money. If it goes sideways and does nothing, you will make money. Even if it goes slightly against you, you will make money. The only time you will lose money is when it goes against you by a large amount. So here, when you're selling those options, right from the beginning, you have a 4 out of 5 chance of making money. Remember, 80% of those option contracts expire worthless. That's the premium you're collecting when you're selling those option contracts. Okay? So a big part of options is understanding the relationship with time decay. Okay? Now, when you decide on an expiration date for your option, if you're going long that option contract, the more time you give yourself, the better. Okay? When you're selling, you want the least amount of time to expiration possible, and here's why, and this is the time decay. Remember that out of the money portion of that option contract, or the extrinsic value, that time value will start to erode from the day you purchase that option. But here's that line I want you to pay attention to. And as the more time you have, you'll see that it's a gradual effect. It erodes gradually. But once you get within the last 30 days to expiration, that time erosion accelerates considerably. Okay? So when you're long an option, you want to give yourself at least 3 months, if not more. And when you're selling it, you want to give yourself 30 days. The longest I'd go at is 40 days. 40 days or less to expiration, that would be ideal when you're selling an option contract. Okay? So there's dozens of option strategies. You can just go long calls, puts, protective puts, you name it, all of these different strategies. The key is to understand when and how to use them. And the real key is to understand that you don't need to trade them all. You only need to trade the strategies that make you money, what you're comfortable with. So I'm going to run through 4 different strategies with you today. We're a little rushed on time, but I'll do my best to get through them. And hopefully this will help you get started with options. So the first strategy is how can you buy a stock like Starbucks for, say, $1 a share? Let me show you how. I'm going to switch to my charting platform here and show you how. Now, this is a chart of Starbucks. It's been a great year, aside from this little blimp here, which took the whole market down. Starbucks has been trending very nicely higher. Now, if you were to buy 100 shares of Starbucks, it's currently at 62.5. That would cost you over $6,200. Okay, so a fair size investment. How can you buy it for only $1? Well, if we go to the option chain here, and remember, we want to give ourselves as close to 3 months to expiration as possible. We'll choose the January expiration here. And let's assume that we buy 100 shares of Starbucks. We spend that $6,200 or so. Now, when you're active in the market and you have that position, you're completely at risk of losing that $6,200. Now, we may think Starbucks won't go bankrupt tomorrow. There's no way it's going to zero, but anything can happen, just like it did here, where it went from the 59 range down to 40 in no time, really in about a week. So it can definitely happen. How do you reduce your risk from the start and make sure that under any scenario you don't lose that kind of money? Well, when you're pairing the stock with options, you can really protect yourself. And here's one way you can do it. If you're going to go along the stock, and first of all, I can say if you don't have the money to buy the stock, you can just buy a call option. And if we look at the $65 strike for January, you can see it's trading from $1.21 to $1.27. So in this particular case, you'll have to spend a little more than $1, but not a whole lot more. Okay, and you can participate in that up move with Starbucks without buying the stock. But let's say you bought the stock. Now we can go to the put side, and what most people would do is buy an out-of-the-money put to protect themselves, such as the $60 here, where you can spend $1.50, and that gives you the right to sell the stock at 60. Now, if that's the case, if you're buying it at 62.5, you're also spending $1.50. That would take your cost up to 64. Yet you're giving yourself the right to sell it at 60. That leaves you with a $4 risk, okay? $4 exposure. How do we shorten that? Well, we can do that by going in the money. So if we look at the $65 strike, we're going to pay a bit more for it. We're going to pay almost $4 for it, okay? About $3.90 or so. So we have to add that to the 62.5. Okay, so that takes our cost to, what is that? Almost 66.5, a little over $66. Okay, but it gives us the right to sell the stock at 65. So that's 66 and change, and we'll call it 66.40 minus that 65. That's $1.40 of risk. Okay, and no matter what happens, whether Starbucks goes to zero, okay, or it goes through the roof, our maximum risk on this position is that $1.40. Okay, that is all we can ever lose on that position. Okay, so and here's the neat trick: if you're in a rush when you're placing these positions and you don't want to try to do that math in your head, all you have to do is look across to the other side of your option chain at that same level strike for the risk. So in other words, remember we said the risk here by buying the stock and purchasing that protective put at the 65 strike was roughly $1.40. Well, if you look over on the call side, it's 121 to 129. It's not going to be exact, but it'll be very close. So a very quick way to assess your risk is by looking on this side. So in other words, if we were to buy the stock and go up to the 70 strike, our total risk would only be around 30 cents or so, okay, on that position. Now, of course, you might be thinking, well, the stock has to go above the strike price that you choose for you to make money. Well, not necessarily. Ideally, you'd want it to be there on expiration, but not necessarily. Why? Because when you're buying the stock, for every dollar the stock moves up, you're going to make $1 of profit. Now, when it comes to your option, if we look over at the delta here, at the 65 strike of the put, it's 66. That means for every dollar move in the stock, that put will move 66 cents. So if the stock goes up, our option here will lose 66 cents for every dollar it goes up. But remember, we're making a full dollar on that stock, so we're actually making the difference there, which is about 34 cents or so for every dollar it moves up. And with every additional dollar, this delta will be lower and lower. We'll be making more and more money on that, okay? Hope that's clear. I'm going to move on to the next strategy, and we'll then I'll answer as many questions as I can near the end. Strategy number 2 is making money with earnings, and before they're even reported. Now, here's the thing with earnings, and I'm going to switch stocks here because Whole Foods Market has earnings coming up. I believe it's tomorrow, yeah, the 4th. And when it comes to earnings, what most people do is try to guess the direction that the stock will gap after that earnings announcements, and go in the day of or the day before, like today, for example, on Whole Foods, and either purchase a long call or a put, or they might do a straddle where they're purchasing both a call and a put. Then the stock will gap after the earnings announcement, and even if it goes in their favor, they'll be shocked to find out that, hey, they most likely have not made money. In fact, they most often will lose money in that situation, even when it's gapped in their favor. Why is that? Well, here's the reason. And it all comes down to implied volatility. Now, I'm not sure about all the other platforms, but on Thinkorswim, they have a very nice feature where when you go to the option chain and you collapse all the expiration dates, if you look to your right-hand side here, there's these percentages. These are the implied volatility figures for each expiration, and what you'll tend to find is that most stocks will, most months will all be around a similar range. So here on Whole Foods Market, it's around the high 40s, low 50s, okay? That's about the average. But what you'll find is that when it comes to an earnings announcement, you'll get a spike in implied volatility. So this week's expiration, because the earnings are coming up tomorrow, this week's expiration is already very close to 120%. Okay? So the more anticipation there is for that earnings announcement, the higher that figure is going to be, and it's not unlikely for it to be over 100% like it is here in Whole Foods. What this means is that as soon as that earnings announcement is released, when the stock reopens the next morning, this implied volatility figure will drop back in line with the average. So in other words, from 120%, it is going to go back down, we'll say, to 50% being the average, okay? That's a 70% drop in implied volatility there. That means that as soon as that earnings announcement is released, you will lose 70% of the value of your option contract, regardless of whether it gaps in your favor or it goes against you. And that's why most people lose money when it comes to trading earnings. So one of the things you can do is try to time that earnings, is pinpoint that earnings date, and then make a note in your journal to look at the chart 3 or 4 weeks before that. And if you have a setup, a proper setup in your favor, and let me just look, because I know Tesla is a much anticipated earnings event coming up tonight. Well, for some reason the chart won't open. That's interesting. Let's give this a second. But we'll see if there was a pattern here on Tesla. Okay, well, if it's not going to open, all right, let me just switch to something else then. Sorry about that. There we go. Okay. So if you can see here on Starbucks, now earnings have already come and gone. But ahead of earnings, Starbucks made a move higher. And one thing you can do is look at the previous earnings announcements to see if that stock definitely moves before earnings, okay? And especially if it usually moves in a one specific direction. So you can time that, go 3 or 4 weeks before, and see if there's a valid signal to enter, okay, based on whatever trading strategy you're using. And if there is, you want to get on board there, get into that position, because not only will your options appreciate in value based on that move, if it moves in your favor, but they will increase in value just based on that implied volatility spike, because when you buy it, it'll still be around that 50% implied volatility, that average number for that stock, and then it'll start to work its way up to that 120%. So even if the stock moves sideways, your option is gaining in value. Okay, not only does it improve your probability of profit, but it helps you eliminate a lot of the risk from owning that long option to begin with. Okay, so you can get both the appreciation in the option based on the move of the underlying, and as well as the spike in implied volatility. So this are usually some very powerful trades. All you want to make sure of is that you sell that option before earnings are released, or you risk losing all that profit. Okay? Let's move on quickly. Here, strategy number 3, how do you protect your portfolio and lock in profits? Remember at the beginning I said with options, you have a lot of options, and this is key. Think of it this way. If we had gotten into this Starbucks trade early on here, this had given us 2 signals based on the strategies we use right here, and it made a nice move higher. So we're in this, and we're thinking it's probably going to continue, so we don't necessarily want to sell our position. We want to hold it for further gains, but we're worried about it turning around and giving up our profit. So what can we do? Well, let's go back to that Starbucks example that I showed you earlier in January. Let's say we had bought the stock, and we had bought that 65 protective put here for January. As the stock moved higher, this option would lose money. Okay? So if the stock moved, say, $2-3, and we lost about half our value here, we lost $2. We went from roughly $4 down to $2. Okay? So we made the gain in the stock. We're down on the option, but overall we're positive. And we want to lock in gains and eliminate our risk to continue holding that position. Well, one thing you can do is roll up your put option. And the way you do that is you would sell your 65 option for whatever you can get, which is roughly the $2, and you would buy the 70. Now, in this case, the 70 would have lost value as well. It would have gone, say, from 7 or 8 down to about 4. So if you're losing 2 here, you paid 4, you're selling it for 2, and now you're buying it again for 4 up here. It means you're net down $2 on your puts, right? But by going from the 65 strike to the 75, you've moved up 5 points on your strike price. It's cost you $2 to do it, but you've gained 3 on a net basis here. And now you have the right to sell your Starbucks shares at $70 any time between the day you do that and expiration. Okay? So what you've effectively done is locked in a higher selling price for yourself. And not only that, but the other thing you can do to bring in more premium and lower your cost basis is by selling a call against those shares, a covered call against those shares. Now, remember, we would have bought in here and the stock has made a nice move. So what would happen to the calls? or they would increase in value. So while your puts were decreasing, your shares were going higher, but the value of these options were going higher as well. So now you wouldn't sell them for 30 cents. They'd be much higher. You'd be taking in more premium, lowering your cost basis overall, and locking in a higher guaranteed sell price, now being that 70 strike. Okay? And the higher this moves, the more you can do this and lock in more profit and bring in more premium. Worst case scenario, the stock turns around and starts dropping like a stone. Well, remember, you're completely protected. Number one, you can't lose any more than what you've paid, but because of the premium you've collected, you've lowered that cost basis. You could completely eliminate that risk, but no matter what happens and no matter how low Starbucks goes, you always have the right to sell those shares at that $70 strike price anytime between now and the January expiration. Okay? One more I can try to squeeze in here before we have to move on. How can you generate a steady income every month? Remember what I showed you, the option sellers are the ones who really make money. So how can you do this on a consistent basis? Well, there's one strategy that allows you to do this quite safely, and you can do this now that there's weekly options on hundreds of equities. You can do this on a regular basis, and that is with a strategy known as credit spreads. Okay, so let's use this. Actually, I'm going to switch to a slightly better example, and that's Facebook. I know many of you most likely trade Facebook. It's a very popular stock. Not quite sure what's happening with my Thinkorswim platform today. It's taking a little longer here. Let's just actually, okay, we don't have a lot of time. Let me switch back and see if we can bring up that chart of Starbucks again. Okay, we'll give this a moment. Now, when it comes to credit spreads, what you're doing with a credit spread is you're selling the higher strike, and for a put credit spread, for example, you're selling the higher strike and you're buying the lower strike for protection. As soon as this comes up, I will show you. Let me try to switch to something else here and refresh this. Okay. Okay, never mind. Let's just use, I'll just use this chart. It's a chart of the Dow Jones futures. It really doesn't matter. Here's what I want to point out to you. Let's say that for whatever reason, we pinpointed this area as a buy, okay? There's no real pattern there. I'm just saying, just for an example, we identify a signal to go long here when the Dow was over here. Now, at that point, if this was a stock, we could just buy the stock to go long. We can buy a regular call option to go long, or we can buy the stock and a protective put. But the other thing we can do is sell a put credit spread to collect premium and give ourselves a higher probability of profit. Now, when it comes to credit spreads, the real key is where you put them on, and more specifically where that short strike is. So what you'd be doing is selling a short strike, selling one contract and buying a lower one for protection. Now, what you want is a couple of areas of support and resistance between the current price of that underlying and your short strike on that credit spread. So let's use the cloud here, the top and the bottom portion of the cloud. Here, typically when you're using the Ichimoku cloud, if the price action comes back towards that cloud, the top and the bottom end are support areas. So the stock will tend to either bounce around there for a while and bounce off it, or slowly break through and then stall again at the other level. So we're going to use these two levels. So when, and it doesn't have to be the cloud, it can be just regular areas of support and resistance. But when you're doing this and you're trying to identify the area for the credit spread, you want to go below those two areas, okay? So now, remember what I said, when you're selling an option, if the underlying moves in your favor by a great amount, you're going to make money. If it moves slightly in your favor, you're going to make money. If it moves sideways, you're going to make money. Even if it moves against you, and in this example, even if it moved from here, not only down to here, but even if it moved all the way down here, okay, you would still make money, because as long as it doesn't get below your short strike, you are completely fine, okay? The only time you will lose money is if it gets below your short strike. So this is why almost 80% of contracts expire worthless, and when you're selling a contract, you have a 4 out of 5 chance of making money. Just remember, if you're selling just a one strike, you leave yourself uncovered. So if you get a gap below huge, you're exposed. That's why you want to buy a lower strike for protection. Okay? Now, let me move on quickly. If we have any more time at the end, I will come back and add a few more tidbits there. But let me just move on and recap the advantages of trading options. And the main one is cost efficiency. As you've seen, you can trade them with a very small account, a very small amount, and you can leverage them with a larger account. In other words, to take that position on Starbucks would cost you $1 or slightly over, compared to $6,200 of just buying the stock. The other key is that because you're spending less, you're taking on a lot less risk. Okay, options can be extremely safe if used correctly. You can also have much higher returns because you're spending a lot less, and again, you can leverage these. But the real key, the real benefit I like the most, the real reason why I trade options, is the greater flexibility. Okay, you always have many options with options. So I know there are a lot of questions, and we'll try to get to as many as we can. I just want to let you know about a Crush the Market with Options Pro class on-demand recording that we have available. And in this class, what I go through is I teach you how you can make that steady weekly income using credit spreads. I will go through this in detail, not only show you where to put them on or how to put them on and give you several examples, but I'll show you how to repair the ones that go against you, okay? I will also teach you butterfly spreads, which most people think are very complicated. I'll break these down. They're actually quite simple to use, and the real benefit of a butterfly spread is that you're usually giving yourself a 1 to 10 risk-reward scenario. In other words, you're spending $90 or $100 to make $1,000 in profit. It's a great strategy. It can be used for earnings as well as other times during the year. I will also teach you a couple of different delta neutral strategies for those times when the market or that particular stock is trading sideways and not doing much, a very quiet period. There's a couple of strategies you can put on and still make money when the market's doing nothing. And a key to all the different types of strategies are the repair strategies. And I'll give you a few different ones that you can use to not only repair trades that have already gone wrong on you, but ones that you can have in your toolkit, so you know ahead of time exactly what your risk and what you're going to do to avoid that risk. The link for this class is tradingwins.com/crush. Now let me tell you exactly what you're going to get so you know that it's right for you. As soon as you place your order, it takes about a half hour or so to process. You'll get a link to the on-demand recording of that pro class. You'll have access to it for life. You can access it from anywhere with an internet connection. It's an on-demand recording. You will also receive a complimentary invite to any future Crush the Market with Options live class we have. We do these sometimes on a quarterly basis. Any new live class we have coming up in the new year, you'll be able to attend free as many times as you like. And another real benefit is that we're going to throw in a 30-day membership to our Pro service, and that's a key part of this. Our Pro service is the most powerful way to get access to all our systems. You'll get real-time trade alerts. You'll get premium nightly videos every Sunday to Thursday that I'll teach you how to trade our various systems and highlight new trade setting up almost on a nightly basis. You'll also have access to our members-only weekly live market chat. You'll get to come into our room and ask me any trading-related questions you like. And actually, if you're ordering today, you can join us this week. This Thursday is our next class. Come in and ask any questions that you have after watching the on-demand recording. And you'll also have access to all the library of past educational sessions available on our website, hundreds of hours of video that you can watch at your leisure. This is a $691 value, but we really want you to see what we do here at Trading Wins, so we're offering it to you for only $47. The link again is tradingwins.com/crush. $47 available for the first 50 people. This is everything you're going to get. I know I don't have a lot of time. We'll try to squeeze in a few questions. I'm going to bring Raul in, our coaching coordinator, to help me read some off so we can get through as many as we can before I need to turn it over to the next speaker. Raul?
It's always glad to join you. Awesome presentation as always. We never have enough time for these things. John was asking how much of the content is different in the Pro class than what you taught today?
It's much. The Pro class is about 3.5 hours in length. We go through everything in detail. Again, here we did not cover the butterfly spreads. We did not cover the delta neutral strategies, the repair strategies. I go into much greater detail with the credit spreads. There's a lot of content.
Janet says, depends I'm trading with a small account. This is a question that comes up all the time. Is this course appropriate for me?
Absolutely, absolutely. The key with options when you know how to trade them correctly is that you don't need a lot of money. I'm completely risk averse. I'm very conservative, and that's why I almost exclusively trade options.
A couple of questions came up. What happens with the 30-day membership at the end of that?
Yes, so if you're enjoying the membership, you don't need to do anything at the end of the 30 days. It will automatically renew at $97 a month. But if for whatever reason you'd rather not continue, just give us a call before the 30 days are up and we'll put a stop to it.
How quickly will the course be delivered to me? That's from Phil.
It'll be a few minutes to a half hour, as long as it takes for your order to get processed.
Okay. Len was saying, when does my Pro membership begin?
It can begin right away. Our staff will set you up. Oh, okay, they're waving at me. They're saying about 10 minutes. 10 minutes.
Sheena's saying, Vince, I've attended your classes in the past. How many of these strategies during the Pro class, what you would call complex versus simple?
Well, here's the thing. Many of these can be very complex. What I do is break it down and give you the key concepts that you need to know and understand to use them. But that will make it very simple for you. Okay, so I'll break it down and make it very simple for you.
Kevin says, Vince, I've attended this class in the past live and well worth the money for anyone who's looking to learn about options. This is the best way to go. Thank you, Kevin, for the kind words. We've just got a couple of seconds left. Vince, can you just remind them again how to get the course?
Sure. So it's tradingwins.com/crush. The link will be in the chat box. You can just click the link from there. This is everything we're going to be teaching in the class, and this is everything you're going to get. So you're going to get access to that on-demand recording. You can attend any future Crush the Market with Options live class for free as many times as you like, and you'll get that 30-day membership that'll be set up in the next 10 minutes or so.
30 seconds. Mark says, do you take American Express? Yes. Anderson says, is there a phone number where we can reach you? It's 1-888-574-2426. We'll put that in the chat box. While we're doing that, I want to say thanks to Reed and the rest of the wonderful folks at Investor Inspiration for inviting us here once again. We always enjoy these. Vince, last word.
Yeah, thanks again, all of you, taking the time to join us today. Hope you got some value out of this. I know you will from the class. Again, it's jam-packed. There's a lot of information in there.